Hi, my name is Allan Madan. I'm a chartered accountant and a tax expert in the Mississauga, Toronto, and Oakville regions of Ontario, Canada. Today's short video is about Americans working in Canada and taxes. So if you're an American working in Canada, it's very important that you watch this video because there are major tax implications that are going to directly affect you, especially since Canada is a very high tax jurisdiction country. There are 7 major tax implications that I'm going to address. Number 1, non-resident versus resident. Non-residents of Canada are liable for tax on only 3 types of income. Employment income earned in Canada. Number 2, business income earned in Canada. Number 3, gains from real estate sold in Canada. So if you're a non-resident and you fall under one of those 3 scenarios, that's the only time that you'll have to pay tax in Canada. As a resident of Canada, you are liable for tax on your worldwide income. That's income from all sources in all countries, outside of Canada and inside Canada. Obviously, your preference is to be a non-resident as opposed to a resident of Canada in order to limit your tax exposure to Canada. So how do you know if you're a resident or a non-resident of Canada? There are 4 major factors that you need to look to when determining your residency status. Number 1, where is your permanent home? If your permanent home is right here in Canada, then you're more likely to be a Canadian resident. On the other hand, if your permanent home is in the sunny state of Florida or somewhere else in the US, you're more likely to be a non-resident of Canada. Number 2, where are your spouse and children? I hope you know where they are, but if they're here with you in Canada, you're more likely to be a resident of Canada than a non-resident. Number 3, where are your personal possessions? Personal possessions include your furniture, your equipment, your clothing, appliances, financial assets, and so forth. If the majority of your personal property is located here in Canada, then you're more likely to be a Canadian resident than a non-resident of Canada. Number 4, are your ties stronger to Canada or to the US? If they are stronger, your social ties stronger to Canada, then you're more likely to be a Canadian resident as opposed to a non-resident. Now, it's important that you look at the 4 factors as a whole when determining your residency status, as opposed to looking at each factor individually. Number 2, the second major implication for Americans working in Canada is something known as the 183-day rule. The 183-day rule simply means that if you're working or living in Canada for more than 183 days, then you're deemed to be a resident of Canada, which you don't want to be because we talked about the bad implications of that. So how do you get around that? Well, you look to the Canada-US Income Tax Treaty. And within that treaty, there are rules very similar to the residency rules, those 4 factors which I just talked about, that help you determine whether you are a resident of the US or a resident of Canada. If you're found to be a resident of the US under the treaty rules and a non-resident, or a resident of Canada under the 183-day rule, the tax treaty will trump the 183-day rule, which means that you will be a resident of the US and a non-resident of Canada. So it's important to look to the US-Canada Income Tax Treaty. Number 3, the third major implications for Americans working in Canada is that you must file a Canadian income tax return. You don't get away from it here. You have to file the tax return by April 30th of the following year. That means any income that you earned from January 1st, 2011 to December 31st, 2011 must be reported on your Canadian tax return and filed by April 30th, as well as any applicable taxes must be paid at that time. The 4th major implication for Americans working in Canada is to look at which scenario are you going to fall into. And there's 3 scenarios that I've commonly identified among my client base. Number 1, you are working for a Canadian employer as an American and you receive a T4 slip from your Canadian employer. A T4 slip, for those of you who don't know, is very similar to your W-2 slip. It reports the amount of income you earned in Canada and the amount of taxes that have been taken off your paychecks. That T4, by the way, gets reported on your personal tax return and you pay tax accordingly. The second scenario that I find my clients falling into is that they receive a W-2 slip from their US employer and only work for a couple of months here in Canada. Well, just because you got a W-2 slip and not a T4 slip, that doesn't mean you don't have to pay Canadian income tax. You still have to pay Canadian income tax based on the days work here in Canada. So let's take a hypothetical example. Let's say you made $100,000 and that's reported on your W-2. And 10% of all of your working days in the year were right here in the Great White North in Canada. That means that you must pay tax on 10% of your income in Canada, and that will be reported on your Canadian personal income tax return. The third scenario that I've seen most of my clients fall into, and you don't want to fall under this scenario, is that you receive a W-2 slip from your US employer and you also receive a T4 slip from your US employer. So taxes are getting deducted from your paycheck twice, once for US payroll taxes and then the second time for Canadian payroll taxes, leaving you with a teeny bit of money left to pay for your bills. How do you get around that? Well, you contact someone like me, or perhaps you do it yourself, and you file a waiver for the reduction in your US withholding tax to compensate you for the taxes you're already paying here in Canada. That's again known as a W-4 slip, and it's a reduction of your US source withholding taxes. The fifth major tax implication that I'd like to talk to you about is foreign tax credits. As a US citizen or a green card holder, you're required to file a US personal tax return and report and pay tax on your worldwide income, regardless of whether or not you're working in the US or living in China or India. It doesn't matter. Because of your citizenship or because of your green card, you must file a US tax return and pay US tax on your worldwide income. However, to compensate you, you do receive a foreign tax credit on your US tax return for the Canadian taxes paid, so you're not subject to double taxation. The sixth major implication that I'd like to talk about that impacts Americans working in Canada is the 401k and Social Security taxes. Well, if you're getting 401k and Social Security taxes deducted from your paychecks, and you happen to also have a T4 where you find yourself having to pay into the Canada Pension Plan and into the Employment Insurance Plan, you're basically paying Social Security taxes 2 times, which you don't want to do. In order to avoid that, you can get a certificate of coverage from Canada that would exempt you from paying Canadian Canadian Social Security taxes, also known as CPP and EI premiums. That way, you save yourself from paying taxes twice. The seventh and final factor that I'd like to talk to you about that impacts Americans working in Canada is if you have foreign assets in excess of $100,000 as a Canadian resident. In that particular case, you'll be required to disclose all of your assets, whether outside Canada or inside Canada, having a cost of more than $100,000. If you fail to file that reporting form, you'll be liable for significant penalties. I really appreciate you watching this video. I encourage you to visit my website, madanca.com, which is shown at the bottom of this screen, to get more tax tips. So go ahead, visit my website, get some more free tax tips, and make yourself wealthier. Thanks for watching.